Open any trading platform, and you are immediately hit with a wall of raw data, a flickering grid of rapid-fire numbers and jagged lines. But that noise is actually a record of human behavior. It is a live, minute-by-minute ledger of a psychological tug-of-war between buyers trying to push prices up and sellers trying to drag them down. To make sense of this conflict, we use a visual system that dates back hundreds of years. Long before modern stock exchanges, Japanese rice merchants invented a specific method to map out the emotions of their trading floors on paper. They created the candlestick chart. By organizing raw price fluctuations into distinct geometric shapes, this tool cuts through the noise, mapping out the shifts in human sentiment that often precede a price reversal. At its core, a single candlestick has two physical components. You have the thick central block, called the body, and the thin vertical lines extending from the top and bottom, known as the wicks or shadows. The body represents the bulk of the action. Its top and bottom edges show us exactly where the price opened at the start of a trading period and where it finally closed when the clock ran out. The wicks tell the rest of the story. They stretch out to mark the absolute highest and lowest prices that the asset briefly touched during that same period before retreating. To see who won the session, we look at the color. A green body means the buyers won the period by closing the price higher than it opened. A red body means the sellers took control, forcing the closing price down. Knowing who won the day is a helpful start, but the true predictive power lies in how they fought. The specific physical shape of the candle reveals the intensity of the battle, and that shape can warn us when the odds of a price reversal are increasing. Before reading a single shape, you have to look at where it appears on the chart. A candlestick pattern only carries weight if it forms at the extreme edge of a trend, the bottom of a crash, or the peak of a rally. When we look at those extremes, we are searching for the first psychological state, exhaustion. This happens when one side tries to force the price further along the current trend, but is rejected by the opposition. This downward trend bottoms out with a shape called a hammer. It has a tiny body and a massively long lower wick. This shows sellers drove the price lower, but a sudden surge of buyers pushed the price back up toward the open. The exact same dynamic plays out at the peak of an uptrend, creating a shape called a shooting star. Here, a long upper wick shows where buyers tried to stretch the rally higher, but sellers stepped in and pushed back. These unusually long wicks are the physical record of rejection. They show that the dominant trend has entirely exhausted its momentum, signaling that a reversal may be approaching. Sometimes, the battle doesn't end with a clear rejection. Instead, we see our second psychological state, the standoff. Buyers and sellers fight for control, but the period ends in a tie. We identify a tie by looking for a shape called a doji. It looks like a literal plus sign, or a perfect cross shape, because the opening and closing prices are exactly identical. The body is flattened into a single horizontal line, but those vertical wicks extending from the center reveal massive volatility. The price swung up and down throughout the day, yet by the closing bell, neither side could hold any ground. You will sometimes see variations of this, like the dragonfly doji, where buyers pushed back from a deep low, or the gravestone doji, where sellers pushed down from a high peak. Both variations still close exactly where they started. When a doji forms at the end of a long, aggressive run, it is a signal of market indecision. It tells you that the momentum fueling the current trend has evaporated. This brings us to the final psychological state. It is not a tie, and it is not a subtle rejection. It is absolute dominance. This state is represented by the Marubozu pattern. It is defined by its sheer size and its complete lack of wicks, indicating a lack of resistance from the opposing side. In a bullish Marubozu, the buyers take complete control the exact second the market opens. They push the price higher every single minute until the session closes, forming a massive green wall with no upper or lower shadows. The opposite is a bearish Marubozu. This massive red block forms when sellers steamroll the market, giving buyers zero room to push back. When a giant Marubozu block prints against the prevailing trend, it is a strong signal that market power is transferring, providing a clearer outlook on where the price may head next. Now for a reality check. Seeing one of these shapes on a chart is a lot like looking at a weather forecast. Dark clouds mean it might rain, But a single candle is not a mathematical guarantee that the price will turn. That is why professional traders rely on confirmation. Before risking any capital on a hammer or a doji, they wait for the very next candle to form, ensuring the market is actually moving in the predicted direction. And they build in an ultimate safety net, the stop loss. Using the extreme tip of a candlestick's wick, traders set a hard boundary. If the price crosses past that extreme tip, the pattern is invalidated, and the system automatically closes the trade. The stock market is not a random casino. It is a real-time, global mirror of human fear and greed. By reading these single shapes and managing the risk, you can begin to decode the psychology of the crowd and find the signal hidden in the noise.